The weakness on Monday and the subsequent rally today, is this giving you any kind of all clear?
Well, no, I think the all clear would really come probably sometime in early 2019. The reason is we need resolution both on the rates front and on the trade front. And maybe the Fed says things to soothe things down, but on the trade front, there's no clarity. Until we have that, the uptrend in the market it cannot be very sustainable in our view.
Do you think, has the market graduated, Krishna, from trade political concerns to overall slowdown concerns, or would clarity on the trade front be enough?
Well, so I think that is absolutely true. I think the market sentiment today is meaningfully different than what it was in September and October. And the expectation that we are facing a recession, which is being built in our view, is just not correct. So I think that part also in the new year, as we get closer to a more robust economic picture, I think that will fade as well.
Jim, you agree that the markets are sort of hostage to rates and trade right now? How did that happen? Because it seems like for a long time, I mean, the opposite was the case. The market was ignoring overseas issues, including trade tensions, and rates were more seen as a response to the market surge.
So look, there's no inflation. We've got earnings growth maybe slowing, but it's still not no growth. We've got a slow growth, not no growth economy here at home. Rock solid fundamentals like stepping stones across a rushing river of event-driven news. The problem is that river is rising, and it's not just trade talk. It's not just trade war concerns. It's not just interest rate concerns. It's also concerns about slowing growth in China, in Japan, in Germany. Across the board in Europe, where we know that we cannot stand alone as a strong economy here if the global economy, whose Fed equivalents have done a very poor job in terms of using buyback options to try and re-stimulate growth, begin to falter more than they currently are. So I don't think that we're going to see an all clear anytime soon. I love the optimism of somewhere early in 2019. But I think investors need to steel themselves for a very difficult, volatile ride that could be significantly longer than just a quarter or two, especially given the fact that in 2019, we are going to see the presidential election campaign really begin to ramp up. And it's going to be, as it has been this year, negative, worrying, concernful, at least on the surface.
Okay, so what I'm hearing from both of you right now is more uncertainty, more volatility going into 2019, which begs the question, Krishna, how should investors be positioned?
Well, I think investors, in our view, should be using the current weakness to add to their exposure in equities and global equities, international equities, emerging market equities. Yes, growth trend is slowing down, no doubt about that. But we are still, the global growth trend is going to be north of 3% in 2019. That's not an environment for a significant drawdown in the market. I think growth slowing, but better policy outcome probably leads to a better market outcome in 2019 than it did in 2018.
Jim, I'll put the same question to you. How should investors be positioned?
Sure, we like battleship balance sheet, blue chip stocks, so say Vanguard dividend growth, Don Kilbride, great risk adjusted career track record. We like Joel Tillinghast, Fidelity low price stock, again, very good global low risk profile. We like healthcare. We think low risk, high return in volatile environments going to continue to favor the healthcare sector. We also like the bond side of the equation. Investors should certainly look to find a good, active, low cost manager, like say Fidelity Total Bond would be a good example. Walk a balanced line from here for, I think, a little while or a long while, maybe as long as all the way through 2019, and you'll be able to get across that river of event-driven news. That is, unless and until we see something else materialize that could have a negative impact on what is a market that we think is prone to investor psychology more than focused on the fundamentals.
Krishna, a couple things. One is we're just now crossing the tape that buybacks for Q3 surpassed $200 billion. That'd be the first time ever for Q3. And just when you get, some positive news like that, oil down now almost 230 here, below 48. I mean, is this a year-end positioning thing? Is this worries about oversupply? Is this worries about demand going into 19?
I think it's a market reaction to expectations of global growth slowing down to trend growth rate. It's that more than anything else. I think, and having said that, I think because growth is still going to be robust, the outlook for oil prices and for the rest of the market, for that matter, I think is much better in 2019. The issues with respect to growth are real, but they are not so bad that the market has to get into the sort of funk that it has been so far in November and December.
Jim, going back to, you were talking about what you like in the market. What about tech? And I'm not talking about the usual suspects, the big FANG names, Apple, Microsoft. I'm more curious about the smaller, kind of mid-size tech names that perhaps haven't gotten as much attention and love in the market over the past several months. Are there any kind of subsectors within tech that you still find interesting?
We think there definitely are, and there are definitely names there. We think the best way for investors to approach it would be through active management, say from PrimeCap or Steve Dufour, Fidelity Focused Stock. These are managers whose track records in terms of stock selection, in particular regard to the technology and the biotechnology sector, stand the test of time, not just bull market times, but also bear market times.